back on Morning Movers. Shares of Domino's Pizza outperforming the S&P 500 so far this year, up more than 10% heading into the company's earnings report on Monday morning. Current estimates for the quarter are for adjusted EPS of $4.12 a share on the revenue of $1.12 billion. Analysts at Baird and Barclays both updated price targets this week. Baird has $535 price target and an outperform rating on the stock, signaling upside from here. Barclays is more bearish on the name with an underweight rating and a $425 price target. So split views on this one. Time now for Options Corner. Joining us to take a deeper look at Domino's, we've got Rick Ducat, lead market technician here. All right, Rick, so talk to us about the trends that you're paying attention to when it comes to the chart for Domino's.
Sure. A member of the consumer discretionary sector, but not really very well correlated to it. You can see Domino's underperforming both its own sector and the broader market, down about 1.3%, while its peers are up 8.6 and 11.3% during the same period. So when we look at our candle chart more specifically, we can see that it's been largely, kind of sideways here. We have made some swings to the upside and the downside, but for the most part, for the past, maybe 2 quarters or so, sticking largely within this green line here, 425, and this red line here near about 500. So we can see now that after bottoming out several times at that 425 level, price is climbing. We are above our moving averages once again here, uptrend in play. The moving averages are starting to diverge, with the faster ones accelerating away from the slower ones. So the trend for now does seem to be showing some signs of life here. However, we are coming up to this resistance area near 500. This marks our old high here, as well as a previous low point and then subsequent high point. So old support became resistance now. RSI still trending downward here, but on the verge of a bullish breakout there. That could be a bullish signal generated, but really, price is the more important thing. One other thing to point out, bullish engulfing candle formed yesterday. Yesterday's big green candle swallowed up the previous day's smaller red candle here. So if we were to take a quick glance at volume profile here, the heavy volume starts to pick up again near 520. That could be a further resistance area to consider. To the downside, 21-day EMA lines up with another volume node near 467.
All right, those are some of the levels to pay attention to there. That's Rick Ducat, lead market technician, with a look at the chart for Domino's. Now to take us through an example trade, we've got Tom White, senior options contributor and co-host of Fast Market. So Tom, how would you go about an example trade, especially in light of earnings coming up for Domino's?
Yeah, Diane, for next week's options that expire on May 2nd, implied volatility levels really elevated at this point. And as Rick mentioned, this stock's been trading in a pretty tight range over the last couple of quarters. So it's been, range bound. So I looked at a strategy that takes advantage of higher implied volatility, but with a neutral type bias here where you don't think it's going to move much. Now, one of the things you have to consider is the option market's pricing at about a plus or minus $25 move either way in the shares. And the float in the shares, the number of shares outstanding, only 34 million. So one of the lowest out there on the street. Some stocks have 5 billion share float. This has 34 million only. So you got to take that into consideration. Bid-ask spreads are really wide on this high-priced stock. So keep that in mind before placing any trades in a name like this. But I looked at a neutral strategy out in the May 2nd weekly cycle. So you're going to capture that earnings event on Monday morning, where I'm going to sell an out-of-the-money put vertical. I'm going to sell the 460 put, and I'm going to buy the 455 put. So a short $5 wide put vertical that's out of the money. And then above the current share price, I'm going to sell a call vertical. I'm going to sell the 520 call and buy the 525 call against it. So a short $5 wide call vertical. So you combine these two short verticals, creating a short iron condor, $5 wide. You're collecting a credit of about 270 on that spread. That's what you can make on this spread. You can see here from the risk profile, you can collect 270. That's what you can make. Your risk is about $230 either way in the stock. But you can see the break-evens, pretty wide range for this stock to trade in. 457.30 on the downside, and then 522.70 on the upside. So you've got a nice wide range here for this stock to trade in. As Rick mentioned on the charts, it's been consolidating in a range lately. This strategy takes advantage of that same theme. And after the earnings event, we'll see that vol crush. This is a short volatility type strategy. And then time decay also works in your favor on this one as theta contracts the price of this, which is the idea on this type of strategy. You want it to stay in between those break evens, but you want to keep that entire credit or close it early at a lower price point than what you sold it for.
Okay, so it's a neutral strategy here. And Tom, really quickly, is there any risk that you have to pay attention to with this example trade?
There is. You get an outsized move, more than one standard deviation, either to the upside or to the downside. That's the risk on this type of strategy. You just don't want this stock to go bonkers and go up to 600 or down to 400. But that being said, it's still risk defined, Diane. You know exactly what you can lose on a strategy like this, which is $230 per spread.
All right, at least it's risk defined.
Yeah.
That's an example trade for Domino's Pizza. We've got earnings coming up on Monday. Thank you, Tom.